Hello and welcome to the Mutual Fund Show. I'm Niraj Shah. The next 20 minutes, we'll talk about actually one key aspect of mutual funds, but in 6 different ways. Confused? Let me try and clear it for you. I what I thought at the start of the year we should do is try and invite two people who eat, sleep, breathe financial planning and mutual funds, and try and ask them what are the two or the three best practices that they are imbibing in their mutual fund investing journey for 2023. They could be different from 2022 and the previous years. It could well be continuation of the same. It could be slight tweaks as well to the existing strategies that they have for their mutual fund investing. And on the show today, um, Ashish Shanker, as well as Ethan Shah. They need no introduction, both of them. Thank you so much, gentlemen, for joining in. And at the onset, wishing you both a very happy new year. Um, the idea of this show was simple, as I told you before the show, that the idea was to try and figure out what is it that you are um, including in your mutual fund investment practice for this year. I'll start off with alphabetically, Ashish. I'll start with you for the first one, then go into Keaton, and then reverse the course as well. So tell us, Ashish, about the first mutual fund investment practice that you are either already there and continuing, or freshly imbibing in your investment practice.
Right. So let me start with something that I intend to accelerate this year or start. See, what happens is over time, and I'm sure this happens to a lot of investors, you tend to collect a lot of funds in your portfolio. I mean, over time, someone gives you a recommendation or there is a new launch. You end up investing in too many schemes. So what I'm going to start doing this year is cut the clutter. I want to streamline my portfolio to ensure that eventually I have probably 5 or 6 schemes, because I strongly believe, and this is what we advise all our clients as well, less is more, simple is beautiful. And if you cut the clutter, you're basically making a portfolio efficient and giving it wings to beat the market, because we do this portfolio review on a regular basis. And often we find most customer portfolios have over 10, 12, sometimes 15, 20 schemes. And if you actually do a pass through, you figure that indirectly, directly, you end up holding 400, 500 stocks. And essentially what you're doing is you're making a portfolio inefficient, and beating the index then becomes extremely difficult, which is the whole objective of building an active fund portfolio. So this year I'm going to start by beginning to trim my portfolio and ensuring that I come to 5 or 6 schemes, which is difficult, but I'll try to get there by the end of the year.
Yeah. Are these schemes going to be of a particular segment nature? I mean, how are you breaking it out? Because a lot of people talk about also having a bit of debt this time around in 2023, because that is now, with the rates the way they are, a proper option, quite unlike the TINA factor for equities in the past. So I'm just trying to understand, how are you doing this?
Right. Look, personally, I'm an all equity guy.
Okay.
And which is my second point I was going to tell you about. That's what I want to continue doing, continue having, close to 100% of my long-term allocation into equity funds. All my contingency money is either in savings bank account so that I can access it very quickly, or some amount is in liquid funds. That's the only debt I have. Yes, of course, as an employee, I do have my employee provident fund as well, which I consider as long-term debt. But I pretty much have close to 98, 99% of my portfolio in equities. Of course, this is not for, I mean, everybody's risk temperament and ability to stomach volatility differs. But I agree with you, Neeraj, that this year fixed income is looking pretty attractive with yields having gone up. And when we actually talk to clients and we advise portfolios, we find that debt has become quite attractive, and incrementally money is flowing into fixed income.
Okay. So viewers, the net point is Ashish's 5 or 6 schemes also are largely equity oriented. He's got that threshold and he is an all-out equity man. Keaton, um, one practice that either you are continuing or you are starting afresh in your mutual fund investing.
Neeraj, I think there is nothing new that I really intend to do in 2023. I think the easier and the simpler you keep your investments or your investing patterns or styles, and the more you continue and give it the discipline, I think that is how the portfolio is going to do well over a period of time. But top of my list of things that I really want to continue is to make sure that I follow my asset allocation strategy. I think all of us here on the call will agree of how it is so difficult to understand what is going to work the next year, right? Who could really phantom that gold will do the kind of movement that it did in 2022, or even for that matter, as a sector, what PSU ended up doing, right? So it is going to be difficult for most of us, and specifically for retail investors hearing us, to be able to figure out which asset class and which sector will outperform the next year. So I think largely, ideally, with myself and as an advice, I am a strict follower of asset allocation, and I suggest that most people who are not very professional and don't do investing professionally should actually maintain asset allocation. And as an aggressive investor, probably largely what I do is very simple. I have 70% equity, 20% debt, and I have 10% tactical allocation that I keep doing depending on what I believe will probably work in the near term. Like, say, for example, the current 10% is largely skewed towards China, because I think that is one place where probably I feel that given my risk profile and the ability, I think I should be able to make some alpha out of that tactical allocation. So largely 70% equity, 20% debt, and 10% tactical. And also, while I do equity, uh, again, I follow the same principle that I don't know what is going to work the next year. Will it be large cap, mid cap, small cap? So largely, I have allocation to all three. And I believe, of course, you might want to tweak what weighted do you really want to give to a large cap, mid cap, or a small cap, depending on the backgrounds and how do you intend to invest. But largely, I have allocation to all three, and that's what I do.
Okay. And in terms of all three, how are you segregating this allocation, Ketan? I mean, if you are at a liberty to name some funds that you're looking at, the percentages may vary, but just the names would be helpful.
So I think from a large cap perspective, because of the value style and a little international exposure that PPFAs brings in, uh, that is what I look at from a large cap perspective, the PPFAs flexi cap. Mid cap, I do Kotak Emerging, and small cap is SBI.
Okay. Ketan, I'll stick to you for the second point. You were also talking about either continuing or expanding the bucketing option in fixed income. Talk to us about that.
See, ideally, what happens is, and I completely concur with what Ashish was also trying to say, that there are a lot of people who largely only want to do equities because they understand how the investing is to be done and with respect to their backgrounds. But a bigger challenge that I've seen while I meet investors is that every time there is probably a fall in the market, and everybody in the ecosystem knows that you want to invest more money, but you never really have that extra cash to put in. Right. So one of the major reasons why I have a little dead allocation is for me to be able to use that cash when market falls, which typically otherwise becomes impossible because you are almost generally always invested. Right. And also another problem that I see in the fixed income space is there are a lot of us, end up doing everything in liquid or end up doing everything in one category, because we don't pay so much of attention to fixed income like we do to equities for whatever reason that may be. What I do on the equity side of the portfolio to try and make sure that I don't lose out on the opportunity in the larger scheme of things, I bucket that into three. So liquidity, core, and tactical. What that typically means is, because I'm aggressive, for me, core and tactical is both going to be aggressive. But let's say there is somebody who's a moderate or a conservative investor, you would not want to take a lot of risk on the core and might want to take small risk on the tactical portfolio. But because I'm aggressive, what I'm typically doing is I'm invested across the curve, because you mine data for the last 5 years, 10 years, 15 years, and you would know that the best debt allocation in terms of risk return has always worked out to be spread across the curve. So I do liquid, I do credit, and I do long term. Right. So I do all three. And in my opinion, that also does not hamper a lot of my opportunity cost versus equity. And I always have debt allocation available if at all the market falls and I want to reallocate my portfolio. I use this liquid cash to go ahead and buy equity at lower levels.
Okay. And the names, I believe, are HDFC Liquid on the liquid side, a credit risk fund from ICICI, and a Nippon India Nivesh Lakshya fund.
Correct. Yes.
Are the reasons thereof?
Again, like I said, look, what is happening again in the long-term space, if I have to start talking about the Nippon India Lux first, a lot of these funds where theoretically the durations are supposed to be extremely high, right? But a lot of these funds, unfortunately, don't have high durations in the real world, right? So it's very tricky to just go by the name and then invest, because you are assuming that by the name that category should have long duration, but most of them don't have long duration. I think this is one of the only funds who actually make sure that the duration of the portfolio is actually long, right? And I don't see a reason why, or probably the way I look at it, I love the way ICICI plays with credit largely, specifically to do with the concentration to each sector or concentration to each company that they've given is very manageable. And I think that's the best way to be able to play credit, is because you don't want to get stuck in concentration risk. And if something goes wrong with that corporate tomorrow, I think the hit on the NAV is going to be too large. So they actually do credit, is because today again you go back and check how credit risk funds are done in the market. I'm surprised the credit risk funds have majority AAA portfolio. Ideally, where they should be lower than AAA, but most of them have a AAA portfolio because nobody wants to go ahead and take risk in the market. So both of these funds are true to label in my opinion, and it satisfies the risk that I'm okay to take, and hence both of them.
Got it. Thanks for that, Keaton. Valuable advice. Now, Ashish, I was looking at what you are thinking of, and amongst things that you're thinking of starting from an asset allocator's perspective, create an investment charter. Now, talk to us a bit about this.
Yes. So this has been my experience personally as well as while dealing with clients, that 90% of the outcomes on portfolios are behavioral. When I say that, what happens is it's very easy to say that I'll invest when the markets fall. But you saw what happened during the pandemic, right? Markets fell 40% and clients froze. A lot of people got scared, and we didn't see so much of flows. But similarly, when markets are flying and you're feeling very good about markets, and obviously at that time valuations are expensive, you tend to end up over investing in equities. And like Kirtan mentioned, even in fixed income, what happens is when the returns are looking very good, they are normally looking good when the interest rates have come off. You have mark to market gains, right? And at that point in time, people end up investing in long duration. So our biggest or my biggest learning over the last 25 years of being in wealth management is that if you can manage the behavior side of investors, 90, 80, 90% of your battle is won. So the one of the great hacks to ensure that behaviorally you stick to your plan is writing down that plan. We have a concept called investment charter. Now someone else could call it by some other name, maybe an IPS, but essentially it's a document where you write down how your portfolio will be managed from a longer term perspective, right? And it's not that it is cast in stone. You keep refining it based on your experiences and your behavior, but at some point in time you will get a reasonable sense of how you think your portfolio should be managed and what kind of risks you can stomach along the investment journey. So a simple thing, like Kirtan mentioned, let's say if you're an aggressive investor, you could say that my portfolio will oscillate between 60 to 80% in equity, right? Similarly, you could say that debt could be between 20 to 40% of the portfolio. Now, typically, why a range is because as an aggressive investor as well, if markets have run up and done extremely well, you could set some valuation parameters where you feel that you should actually be a little under allocated to equities, and vice versa. Let's say you hit the pandemic and markets have sold off 40%. Now, instead of trying to predict when the markets will sell off or what will happen to markets, you say that if that event happens, I will do this, right? So you can take some money off debt and put it in equities. Similarly, in debt, I like what Kirtan said, that if let's say 30 to 40% of your portfolio is getting allocated in debt, right? 20% you can do in long duration, 20% you can do in short duration, right? So you're not taking any interest rate risk. But based on how markets move, even within debt, you can veer more towards duration when interest rates go up, and vice versa. And you can also model in, let's say, some gold in the portfolio. Gold is typically an insurance and a protection on the portfolio. And I always tell investors on a lighter note that you should have whatever allocation you feel is appropriate. My view is you should have between 10 to 20%, otherwise it doesn't move the needle. But you should have allocation in gold, and you should pray that it doesn't work. Because if that part of the portfolio is working, which means there's a crisis somewhere in the globe, and the rest of your portfolio is under stress. But even if gold doesn't work and doesn't do well for you, you should be happy, because rest of your portfolio will be fine. So I think investment charter is a very important document. I actually urge and advise all families to do it. And actually, over time, you should share it with your spouse and involve them in the portfolio review process, so that you also create a situation where, if you are unable to manage the portfolio, there is awareness amongst other family members. So this is something which I genuinely believe, if someone has not done, I think this is any time is a good time to start. So basic asset allocation, documentation, what you will do if something happens in each asset class, and similarly, how often do you rebalance? I prefer a yearly rebalance, but over time with your advisor, you can figure out what works for you.
Yeah, well, that's sound advice. And viewers, by the way, if you are in a family which anyways buys a lot of gold jewelry for people in the family, then that kind of forms a part of your gold investments. Maybe you can figure it out whichever way. But I think somebody, one of I won't take the name, but somebody from the markets, a veteran investor, sent me a message 2 days back about how the Indian housewife has been the best investor over a period of the last 10 or 15 years, because gold investments indeed have done well. Much to my surprise, they've actually done really, really well. Okay, the final point, and I want to end with the point that Ashish has as his third point, and therefore for first I'll come to Keertan for his point. And Keertan, it's a very practical advice which you are giving out, just topping up SIPs at every fall.
I think, Niraj, like you rightly said, this advice is more from a viewer perspective, of course, because we as market participants understand this and have digested this facts so much. But the problem is that while somebody is doing an SIP, while they agree, they understand behaviorally, they are in sync with you, that the reason why they are doing an SIP is because you are not going to be able to time the market. And the advantage that probably a systematic investment brings is to make sure that you are just doing it irrespective of what the market levels are. But I don't know, to my surprise, I see a lot of investors who really end up doing the complete opposite, is when markets start becoming slightly more volatile, right? They have the question whether or not the SIP should really be continued, or should they pause? What should they do? Right now, if you look at some basic data points that we've looked at for the last 20 years, out of the 20 years, 19 years, the market has given more than 20% movement every year if you look at the top and the bottom for that year. Now, that's the kind of volatility that the markets have 19 out of 20 years. And that's huge. 20% is huge year on year, right? So if SIP is going to help you solve that problem, because you are never going to be able to time it, right? Why stop it when the times are volatile? Because that's the original reason why you are going with a disciplined investment like that. And also because, like I said, there is this 20% movement from top to bottom in 19 out of the last 20 years. I'm sure you will always get an opportunity at a 5% fall or a 10% fall to top it up, add more money, right? Because it's a no-brainer where we've seen every 3 or 5 year block markets have been doing well. They've been better off, and they've been forming a higher top. Then whenever you get an opportunity of a 5-10% fall, why would you not want to top it up, right? And like Ashish also made a mention that during Corona, markets fell, but people didn't invest more money, and that's the logic, right? So the debt allocation is to make sure that they have the monies to invest, and then you educate them that every 5% or a 10% fall, you top it up, so that practically money is made available and they're educated enough to invest more. I think this is something that I really want to preach and continue, that they should try and top up at every fall, because as a long-term investor, probably these 5%, 10% falls that you're topping up are going to be the biggest alpha generators than anything else.
Look at them as opportunities. Thanks for that, Kirtan. Ashish, the final point, and which is a bucket for charity.
Yeah. So this is something that I've been thinking about for a long time, Neeraj. And what tends to happen is, all of us want to do good, but sometimes we don't know how, or sometimes we get so consumed by our work that this year I've decided, and this is something that I would like to start. 20% of my incremental savings, I want to put it as an SIP in an equity fund and demarcate this money for charity. And this will be a charity which will be close to my heart. I'd like to, invest in education for underprivileged kids. But the larger point, Neeraj, is, if, I'm sure all of us want to donate to good causes. Now, if you can pencil that into, I mean, if you've reached a certain corpus in life and you want to pencil that into your plan, then I feel it makes sense to demarcate a certain percentage of your savings and, create a separate bucket so that it becomes sustainable over time. So that's something that I wish to start.
And you can choose whichever instrument you want to use this for, viewers, if you indeed start, and it could be 5%, 15%, 20%, as the case may be. But gentlemen, both of you, thank you so much for joining us. Some practical advice, some theoretical, and both of these are helpful. So thank you so much for joining us on the show today. Really appreciate your time.
Thanks, Neeraj. Pleasure to be on your show,
Yeah.
as always.
And viewers, thanks for tuning into this leg of the Mutual Fund Show.